This is Larry Williams, and I wish I was in Japan. Unfortunately, I'm not able to be there. I would really like to be there. We have so many great friends, my interpreter, Hiro, Narita, all the gang at Pan Rolling, and so many traders who I've worked with over so many years. I can't be there, but I can present my ideas to you, and I've been really looking forward to that today. So let's get started. What I hope to accomplish today is I want to show you what I think are the driving forces of gold, the stock market, and energy. I think if I can do this, it's going to help you understand the future. So 6 months from now, 2 years from now, you'll have a better ability to deal with whatever the market is doing at that time. So that's the educational part, but I'm also going to be showing you forecasts of what I think the markets are going to be doing to help you in your own personal decisions coming up in the immediate future. This is where I live. Oh, look at this. It's so far out. So do I really live there? Well, no, but yes, I do, because I live in the future, and what you just saw is really futuristic living. Newspapers and most market analysts live in what has happened. That's worthless. The past is over. The past is prologue. We can never know all of the future. We can try to live in the future, but we can get a pretty good idea of what the future is going to be like. But clearly, just looking at the past and saying the market did this yesterday, so what? As investors or speculators, we have to have a sense of the future, and that's what I'm about. That's what this presentation is about, to help you see the future. So how can we know the future? I think there's lots of things that can help us. One would be cycles. I happen to believe there are some significant cycles working in the markets. I'm going to show you those today. Also, the Commitment to Trade report. This is a report issued by the United States government that shows what the small speculators are doing. They're usually wrong. What the users and producers, the actual producers and users of gold, wheat, corn, what they're doing, very valuable information to see what the big guys are doing in the marketplace. Also, fundamental relationships. Clearly, if interest rates go up, that has repercussions in the rest of the markets. So fundamental relationships, they matter. And also, patterns from the past can help us understand. These patterns don't always hold up, but they give you a general idea of what to expect in the future. There's a lot of merit to using patterns in the marketplace. Let's start looking at gold. I think the most important place to start looking at gold is the Commitment to Trade report. This is just critical for both silver and gold because, again, the Commitment of Traders report shows what the big guys are doing in the market. It shows when they're buying, shows when they're selling. Now, they are hedgers, so this will show when their hedge position is aggressively long or aggressively short. Now, this is a huge takeaway lesson for rest of your life. The commercials, the users and producers hedge. They are seldom net long. Oh, but boy, when they get net long, you better be ready. Here's a long-term chart looking at the gold market on a weekly basis going back to 2001, and the commercials got net long right here before the big up move. And they got net long. The red horizontal line is when they're below it, they're net short, above it, they're net long. As you can see, they don't get net long very often. Now, when they start to buy, we start to get buy points in the market. So their buying increasing is very positive towards rallies in the marketplace. But the anomaly is when they get net long, which doesn't happen very often. And when it does, well, here we see it in 2015. They got net long right here. In 2018, net long, oh my gosh, right there, just before the huge up move began. Now, here's where we are today. I know this is what you're looking at. Now, we get long. I don't know if we will or not, but we're approaching it. We see they've started increasing their buying. We know when they increase their buying, that's bullish for the price of gold, and particularly if they get net long. So, ladies and gentlemen, guys and girls, traders, you have to be following this to see if in the immediate future the commercials get net long, because when they do, buy all the gold you can. At that point, you can and should turn into a rip-roaring gold bug. Now here it is in silver. Silver is almost net long. Again, you see the commercials seldom get net long in silver, but when they do, it's a great point to be a buyer. So watch the silver market as well. Now, there's another way of looking at this that's going to help you for more intermediate term trades, and that's to look at open interest. What's open interest, you might ask? Open interest is just the net number of contracts open in a market. A black line is open interest. That's the total contracts that are open in the market. Two takeaway points: when open interest is very high, we're probably at a market peak. When it's very low, we're probably at a market low point. The open interest just shows when the crowd is busy in the marketplace. Well, where are we right here, right now? We're at the lowest level of open interest seen since 2019. We're at a low level of open interest. Low levels of open interest tend to be bullish. Of course, we need to back that up with something. What could that be? The commitment of trader report. When open interest is declining and the commercials are buying, in other words, everybody's getting out of the market, but the commercials are the dominant force and they're buying, we are usually close to significant lows in the marketplace. Again, open interest, the black line declining, commercials are buying. Again, we see commercials buying, open interest declining, a low in the marketplace. And that's started to happen now. As the open interest has been declining, commercials have been buying. This will set up a rally in the gold market. So it is a fundamental consideration. This is not a timing tool. We still need timing tools. You need whatever you have. A trend change in the gold market to the upside at this point would be significant. I also like to look at the valuation model because gold, like all commodities, can be undervalued or it can be overvalued. We're looking at gold here on a daily chart, and we see that currently, as we enter into September, it has been overvalued. Look at that, and gold came down. It was undervalued back here, undervalued over here, undervalued here, and gold rallied. So when gold gets undervalued, we should expect a rally. When it's overvalued, especially in a downtrend, we can expect a sell-off. Clearly, markets in a downtrend, we get overvalued. Look for and take sell signals. So what I'm waiting for now is to see if gold can get undervalued. If it does, one more weight on the scale to tell us to look for a buy signal and an entry in the gold market. Silver, the same thing. We can do a valuation of silver. You see the same thing happening here. Silver recently has been undervalued as it was back here and here. It's not a timing tool, but it tells us that we should be looking for or biased. We should expect a rally in the market. So evaluation is a great tool to tell us fundamentally this market's ready to rally or decline. Also, you might use my VIX index. This is available in most of the softwares. This is an indicator I developed in 2008 when I was living in Australia. I wanted to have an indicator that measured the VIX index. It was very expensive. I think it was $60,000 a year to get the VIX index. I could create one of those myself, and I did. It went on to win the Market Technicians Association Award of the Year in a paper that somebody else prepared using my VIX index. And here's the VIX index, gold, on a daily basis. And it does a really good job of telling us when we should rally. When the VIX index gets really high, there's the red line. Look what happens. Market low point, market lows, market low. Oh, missed it there. Bingo, right there, right there. And we've just gotten into the VIX buy area in the marketplace. So this is another indicator. So we're starting to see a culmination of things getting bullish in the gold market here. And certainly the VIX index, which has a nice record of spotting the significant lows because the volatility is so extreme. Here's the takeaway. When markets have extreme volatility, they're at or close to market lows. And that's where we've been recently in the gold market. Well, the golden rules, we always thought that gold was ruled by inflation. When we start to inflate, gold will go up. That is commonly what has been the perspective on the gold market. Inflation is the driving force of gold. Not really. I'm going to break the golden rule today. Now, here's gold and inflation in the 1970 time period, and it was correct then. We started to inflate. This is the consumer price index in purple, and gold goes up. We start to deflate, and gold goes down. We start to inflate, and gold goes up. It was a really good rule until about 1990. It looked like at that time, the driving force of gold was inflation, and that's changed. Here we are now, 1998, 1989, up to 2004. That's a whole different ballgame. Here we had a big increase in inflation, and gold went down. Here we had a big decrease in inflation, gold went down as you would expect, but a big increase in inflation here, and gold went down. What's going on? It's really kind of difficult. Even if we look at the peaks in inflation, they tend to come close to market lows, but not always. So the unique ability that we saw earlier for inflation to predict the gold market has started to wobble and wobble quite a bit. Here it is now up to 2010, And now we start to see how gold has responded to inflation in recent time periods. We started to see inflation pick up and gold picked up. We started to see inflation, the consumer price index and the purplish line come down. And gold actually from here, when it started to decline, that was the low in the gold market, and it started to rally. Even despite this huge decline in inflation, gold rallied. We saw a big decline in inflation here, gold rallied. So that relationship has started to change. Big decline in inflation over here and gold rallied. So we're operating under a different set of rules now. Why? I don't really know, but they are different. And here we are, a more current view. Here we start to see what we'd expect, an increase in inflation and gold goes up, a decrease in inflation, which should operate, but now we get to 2022. We've seen a huge increase in inflation and gold's gone down. In fact, when we saw inflation gold down in 2018, that formed the low in the gold market. And we start to see the inflation go down here, another low in the gold market. So this relationship has started to change quite a bit. I don't think this is any longer the singular driving force of gold. Clearly, that's a lesson of 2021, 2022, big increase in consumer price index inflation, and gold cannot rally. Very interesting. So what else could influence gold? Well, people say deficit financing, money supply. When there's too much money in circulation, gold should go up. Does it? Let's take a look. The green line is money supply, and you see gold from 1970 to 2020, right up to date. Very interesting picture. As money supply increased, gold actually went down. And then as money supply decreases, gold starts to go up. It decreased more and gold went down. So I don't think money supply is the driving force. Some people have thought the deficit spending would drive the gold market or inflation or money supply. I don't find any evidence of that. We can look at the velocity of money, though, and we get a better picture. The velocity of money is how fast money turns over, and now we start to see that the gold market is responsive to the velocity of money supply. We just start to rally here, we do pull back. Gold is following the blue line. The blue line is velocity of money supply. And here we are, right up to date. Notice we had a big increase in the velocity of money supply. Gold rallied. A decrease, gold came down, increase, gold rallied. We had a nice rally and increase in velocity of money supply. Then gold started to fall apart and wobble. But I think this is the important point now. The velocity of money supply has started to go down. And when it starts to go down, we can expect a decline in the gold. So we have to be a little careful about being long-term perpetual gold bulls here, because the relationship of money velocity is not as bullish as it once was. This may be the best predictor of gold, simply the stock market. In green, you're looking at the Dow Jones Industrial Average push forward about 2 months, 2.5 months. In other words, notice that we're saying we should see gold rally from September into the middle, late part of October, and then a decline. And that push forward in the stock index called this peak beautifully, called this decline in gold beautifully. Was able to forecast a rally, and this decline right here and the big rally quite well. So short-term traders, if you're following gold right now, you want to push forward what happened in the stock market about 2.5, 3 months ago, and that's most likely the path, the roadmap that gold is going to follow. So now you too can have a really good understanding of where gold is going right here, right now. I think there's a master cycle in gold. It's about a 4-year cycle where we have big up moves in the gold market, big up move in the gold market, good up move in the gold market. But after we have these big up moves, we crack and then we bounce around for 3 or 4 years and take off again, come down, bounce around for 3 or 4 years, take off again. So you get the pattern there? Now here it is updated in 2006, big up move, bounce around. Whoa, look at that, there we go. The big up move into 2012. So I think this is the best long-term view that we're going to get. And here it is, right here, right now. There's 2009, when we should have had the big up move in the market, and indeed we did. 2017, right here, right there, and we did. Where are we now? We're in the down choppy phase. The next time we get this big up move coming is at the end of 2020. 2025. Notice 2025, this is the same as we see over here. So next time to get really bullish on gold on a long-term basis, based on my cycle concept, is at the end of 2024. I know, I wish it was now. All you gold bugs out there, you think we're always going to be in a bull market for gold, but clearly we aren't. It goes up and it comes down. Not a perpetual bull market. The next time, 2024, the first of 2025, we want to look to be going long. I'm going to blow that cycle up for you now so you can see it on a little shorter term basis. Looks like we should start to pull back in September, October, then we rally into the end of the year, and then we start to decline again. So that's a pretty good perspective of what to expect for now in gold between now and the end of the year. We have about the same picture. A very short-term cycle says we should expect a rally to start about now, a pullback into about the first part of October, then that rally, this is the rally we just saw, into the end of the year. So bullish on gold, yes. I want to buy dips in this market, especially as we get into the first part of October and again around Thanksgiving, the end of November. There's a common idea that gold does really well when we have bear markets and stocks. Actually, it doesn't. When we have bear markets and stocks, usually gold goes down. Or when we have recession. So I wanted to show you this chart. The gray lines are recessions in the United States economy, and the red line is price of gold. Oh, it was a recession, gold did nothing. Recession, gold did nothing. Recession, gold actually went down quite a bit. Then it came back a little bit. But don't get into the idea that recessions are bullish for gold. If we have a recession, gold will go up. In fact, look, when the recession is over, gold went up. When the recession was over, gold went up. When the recession was over, gold went up. We're not in a recession, gold goes up. Not being in a recession is the most bullish thing for gold. Being in a recession is not necessarily bullish for the price of gold. Now, that just turns gold bugs' world upside down, but this is a reality. This is a chart from the Federal Reserve System. This is what actually happened. The message is there. Whether we choose to accept it or not, well, that's up to us. There is another form of gold, black gold crude oil. Crude oil now rules the world. Everybody is dependent on it, especially in Japan. You don't produce it. You don't have it naturally like we are blessed to in America or in Canada or in Saudi Arabia, Russia. So yes, crude oil has a huge influence on everything in the world these days because we all need it to stay warm or to stay cool, to drive cars, to go mine things for electric cars. We've got to have crude oil. So let's look at my VIX index in the crude oil market. Remember, when it gets above the red line, we should look for lows in this market. And you see that's exactly what's been happening. Now, we're not there quite yet. We're getting close to it. But this is an indicator you want to put on your charts that gives you an idea of when we're getting into the next buying opportunity in the crude oil market. There's one indicator for you, but there's more to come. Now we can look at valuation, and crude oil just recently has become undervalued. Look at that. We're in an undervalued zone. Great, I like that. It's not a timing tool. Notice it got undervalued way up here, but clearly we were in a value zone here and here, and we're in a valued zone here. So we're undervalued, so that means we need to pay attention to this market. We can also look at the commercials. What are they doing? Let's look. Remember my lesson on open interest? When I said high levels of open interest, that's the highest level of open interest we've seen. The black line is bearish. Well, it sure was, wasn't it? Low levels of open interest, like we saw here, are bullish. And look at this. We are now seeing the lowest level of open interest since 2014. But we need to look to see what the commercials are doing. The red line, they have consistently been buying. Now, they're not net long. Net long is right here. But when they're buying and open interest is declining, they're buying, that tends to set up nice rallies in the market. So guys and gals, I think we're starting to get up, set up for a rally in the energy markets. Another market we need to pay attention to. Can we get a better picture of it? Let's look and see. Here's my long-term cyclical work on energy prices. Notice about every 2 years, we see a significant low in this market. Low here, buy point here, highs over here. Pretty good cycle. It's not going to be precise, but it tells us we should see that the market stop going down here, start to rally here, start to rally here. Oh yeah, pretty good. And where we are right now is in the down phase of the cycle. And all cycles tell us is be careful here, be bullish here. So it looks like, look at this, the start of 2023, we start to move up again as we did here, That's this rally, and that's this rally, and the rally over here. We can go back and look at, that's this rally right here, this rally right here. That's the start of 2023, right down here. So that gives you an idea of when we could expect the timing of this move to begin, when the cycles kick in to the upside. And I've blown up a chart for you so you can get a little better idea of a cyclical low that starts to come in right around the middle of January. Will this be precise? No. Was this precise? No. The actual peak was here, but you can see the market rolled over following the longer term cycle. That's the important thing. We knew back here that we expect a decline in the energy market, which I talked about on Jim Cramer's Mad Money, that the cycles were high up here. We expect a decline. We've been seeing that. So here's the next time longer-term traders can look for a significant turn to the upside in the energy markets. On a very short-term basis, for you very short-term traders, here's a daily chart or weekly chart, and we're seeing that around the middle of September, latter part of September, we should start to see an up move. Notice the last up move was here and back here and back here. So it looks like we come up starting around the middle of September, up, then down into, oh, look at that, the first of 2023. At this point, the shorter term cycle is in phase with the longer term cycle. So this is going to be a really significant point as the new year begins. But for now, up move, down move, up move. Got it? Okay, let's take a look at stocks in Japan. I've been in this building. Boy, has the Japanese stock market changed from the old outcry market to electronic markets. But still, prices of stocks in Japan are influenced by gold, crude oil, and interest rates in the United States. Those three things just really impact the market, and I'm going to show you today exactly how that works. Here's the price of crude oil, and notice when crude oil rallies, we can see a rally in Nikkei. Crude oil rallies, we rally, decline, we decline, rally. What I've done here is I've projected crude oil prices and moved them forward in time about 5 months. And that's the path that your stock market has been following. It's a bullish path coming up into the rest of this year. We can also look at the bond market and interest rates in the United States, and what happens in interest rates later on affects stock prices. Here you see how the market's followed. Interest rates in the United States push forward, so it says, oh yeah, we've had this little decline, we saw that. It's time to rally, pull back, and another rally at the end of the year. Pretty good idea of the general roadmap that I would expect stocks are going to take in Japan. There it is for you. You've now seen, and now you're with me. You live in the future. Oh, but look at this. Look at the relationship of the Nikkei and gold. The blue line is gold prices, and the black line of this is your stock market. Look how close they are. We decline, we rally. We decline. In gold, we decline here. We start to come up, and we come up, pull back in here. We have a big up move in the Nikkei. We have a big up move in gold. Gold starts to come down. The Nikkei starts to come down. Really close relationship there. It gets very interesting because, again, I pushed the price of gold forward about 5 months. In other words, this is what gold is telling us the Nikkei should be doing. Notice how closely the Nikkei, the black line, has followed the blue line. We want to pay a lot of attention to this now, seeing what happens to the price of gold, but immediately it looks like we're going to have some trouble in gold around the first of the year. And again, what this tells us, a bounce here, does not necessarily tell us the magnitude of the move, but a buy point middle of September, a buy point the middle of October, and a buy point at the end of the year. That's when gold forecasting, just like this low, didn't know how big the rally would be. This low was known 5 months in advance. That's another thing you can use to follow and get an understanding of what will happen in your stock market. Now, stocks in the United States, they're driven by inflation, energy prices, and interest rates. Crude oil also, and I'm going to look at what I think are the most significant relationships in the Dow Jones Industrial Average, which is really a good representation of all stocks in America. Whether that's the NASDAQ, the Triple Qs, the S&P 500, they all have the same general tops and bottoms in the marketplace. So let's look at the Dow Jones and inflation. Inflation has been the big buzzword in 2022. Oh, stocks have come down because we have high inflation. Well, yeah, but let's look. What does history tell us? We had very high inflation from 1989 all the way into 1990. Look at the green, the purplish line is inflation, and stocks rallied. Then we declined in inflation. CPI index went way down, and stocks rallied. Then we started a rally in inflation. Inflation came up during this time period, and stocks came up. Then stocks came down about the time that inflation came down. So we can see stocks rally when inflation goes down. We can see stocks rally when inflation goes up. Is there some perfect number? Well, we had really high levels of inflation here, and stocks still rallied. Tough to draw a conclusion, but I'm going to give you mine in just a moment. Now here we are again. This is a crash of 2008. A lot of people focus on that. Inflation topped after the stock market topped. Inflation bottomed after the stock market bottomed. Very interesting. We're going to look more at that relationship in a minute. Again, we can see inflation come up and stock prices came up. Stock prices got real strong in here as we started to inflate. So I think what's more important in inflation is these turning points in inflation that lead in the future of what's going to happen. Here we're going to look now at 2019. Here's inflation coming down, stocks rally. Inflation comes up, look at that, stocks rally. Inflation comes down, stock can go down. So stock can go up or they can go down. Yet, here's what's happening right here, right now. This is inflation, the purplish line, versus the Dow Jones Industrial Average. And again, we see the Dow bottom prior to inflation. It topped out about the same time as inflation. Notice inflation tends to be a little bit lagging. But when it does turn down, we start to get significant bottoms in the marketplace. And this is where we are now. It's my belief we're seeing inflation abate and we will see a turn down in inflation, which would be a turn down in inflation bullish for stock prices. A turn down in inflation bullish for stock prices. So let's keep that in mind. We want to watch this one closely, and that's my expectation. Now, crude oil also affects stocks in the United States. You can see way back in 2008, that huge bear market that we had. Well, look what happened. The very first part of that bear market, crude oil went crazy, yet stocks declined. Then when crude oil declined, stocks declined. It's hard to find a specific relationship other than, what I'm going to show you, is when crude oil starts to rally, stocks start to rally. Crude oil starts to rally, stocks start to rally. So the turning points in crude oil seem to be more significant than necessarily the trend that we see in the market. And we can project that forward. We're going to take it forward about 8 months. And when crude oil turns up, we would expect a rally in the market. And of course, this is known in advance. Remember, we're looking out in the future. We're living in the future. This point was known really about 6 months prior to the stock market rallying. Same thing we see over here. We see a low made in crude oil. That's in the future at this time. And then stocks rally. So that's where we are right now. About October, it looks like we have another one of these lows, just like we saw here, that projects a rally. And this should be a good rally for the end of the year, using crude oil to forecast stocks in the United States of America. There's a picture for you. Well, the big question, I guess, is what's going to happen to inflation. This has been the driver. It's the front page of every financial newspaper. All the economists are talking about inflation. It's bad, it's horrible. What's it going to do? I'm going to show you right here, right now, what I think it's going to do. And when I found this out, I was staggered. I just had to look and check and recheck because finally we have a pretty good idea of how to predict inflation. First of all, inflation is here to stay. Here's the inflation from the Federal Reserve System. That's the blue line is inflation. Look at that from 1960s all the way up. We have little dips in it when we have downturns in the economy, but inflation is here to stay. We're going to continue inflating, so nothing we can do about that. That's a trend. But we can look at money supply and inflation. Now, inflation is the black line. That's consumer price index. And the red line is money supply. So we see that money supply and inflation can be correlated quite well until they're not. Look how closely this was during the Jimmy Carter era. We increased money supply, we inflated, we increased money supply. Then all of a sudden, that relationship started to break. All the ideas, all those books written in the 1970s about inflation and gold and money supply were based on this data. They didn't know the future, though. And look at this. As money supply has declined, inflation has declined. It's supposed to be just the opposite until this year when we started to inflate. This is the inflation of the last 13, 14 months, and money supply has been down. So we see money supply come down, inflation might come down, money supply comes up. There's a little bit of a relationship there, but certainly it's not a be-all, end-all. Big increase in money supply from 1990 to 2000, and inflation went down. So money supply, probably not going to help us predict inflation. So what does? Look at this. Grab your pens and pencils. Again, the black line is inflation or the consumer price index. The red line is the stock market. Look how closely they parallel each other. Oh my gosh. Inflation peaks when stocks peaks. Inflation bottoms when stocks bottom. Stocks top out, and inflation. Look at that. How close that relationship is. And it continues. 1978, big rally in stocks, big up move in inflation. Stocks come down, inflation comes down. Stocks rally, inflation rallies. Inflation comes down, and stocks start to pick up, inflation starts to pick up. Oh, now coming to 1996 area, same thing. Nice big rally in stock market, big rally in inflation. Inflation comes down, stocks come down. Stocks start to go up, inflation kind of goes back and forth, doesn't go much of any place until right here, right now. And look at this. This is the relationship. All these numbers, all these charts you saw before, was the stock pushed forward in time, like I've been doing with other charts. In other words, this is the stock market, but I push it forward about a year. And look how closely inflation follows the stock market. Same thing we saw back here. Remember, stocks are pushed forward in time. So we knew at this time we had this picture that we should start to decline. Again, this decline was known about a year and a half in advance because I pushed the stock market forward as a predictor of inflation. And look what it's telling us about inflation. We should start to continue to see more deflation at least until 2023, somewhere in early 2023. Maybe we'll have a little uptick in it. We'll see what stocks do. But right now, the forecast for inflation, look how closely stocks have been able to forecast inflation. Inflation, I think, is behind us. We're starting to see, and I believe we'll see, inflation numbers start to decline, which will be bullish for stocks. Another way we can look at inflation is look at the cycles of inflation. There is about a 5.5, maybe 6-year cycle in inflation. You know, if there's a cycle peak, oh yeah, we lose inflation. Cycle peak, we start to deflate. Cycle peak, we start to deflate. Cycle peak, a little early, but we look what happened. And here's where we are right here, right now. We're at a peak in inflation. And we should expect to see inflation go down. That's usually what happens. Does not tell us the magnitude. Maybe inflation will go down to here, maybe it'll come down to that, we don't know. But we do know that the next cyclical up move in inflation begins in a couple of years from now. You know, this is when we see the big increases in inflation. Look at that. Here, here, here. Bingo, right on target. And now we have several years to go before we see this type of hyper runaway inflation that we've seen. It's time now, based on cycles, to look for inflation to decline. Well, let's take a look at my stock market crystal ball and get some immediate forecasts in the market. I hope you've been able to understand the markets a little bit better now, what these driving forces are, so you don't have to read the newspapers about what happened yesterday. You can actually look at your charts and pull up data and get a sense of the future. Okay, crystal ball time, here we go. First of all, the stock market has been led by the bond market this year by quite a bit. The green line is the price of bonds, and bonds have led stocks by about 17 days. In other words, this point, as you can see, was known in advance. This sell-off, all these were known in advance by about 17 days. So what the bond market does now is about 17 days what's going to happen in the stock market. So it's a good short-term leading indicator. This peak in the stock market was known actually 17 days back here because this index is projected into time. as most all of my indicators have done, I've shown today, because we want to see the future. We want to live in the future, right? We can look at short-term cycles as well. They're really helpful. It says right here, right now, we start to rally, pull back, and in October, we start to move to the upside, a little bit of a pullback around Christmas, and another move to the upside. So what do we see here? Buy points right here, right now, buy points in October, and an end of the year buy point. You can see in the past how these have worked. Again, cyclical projections don't tell us how big we will rally. They just say, time to buy, time to buy, time to buy, time to sell, time to sell. Clearly, we now have delineated the next 3 buying opportunities in the Dow Jones Industrial Average and stock prices in the United States. Now you can see them right here in advance. There is a long-term cycle working in the market. I'd like to share my work with you on that a little bit here. This is back 2007, big up move in the market. Yeah, look at that. The big up move is over here again in 2011, right here, big up move in the market. Then what happens? We have these big up moves, we bounce around, a little rally, come down, then another big up move. Then we come around, bounce around, may have an up move. The big one, these are the ones I'm looking for. These are like the sure things. So here they are, following up. The last one was 2014, big up move. And then we start to bounce around. This is this pattern over here. We're looking for when's the next one of these going to happen. And there it is in 2019. And we had a big up move in the market. We bounce around and run up. We have another one coming right now. That's really bullish. And here it is on a longer term base. Let's go back a little bit on this. I think we've started a 2-3 year bull market here, because in the past, this cyclical low has been here, and it's been here, and it's been here. These have been marvelous times to be a buyer. I'm probably the last person left on the earth that think we're going to see a 2 or 3 year bull market now, but I think we are. And here's what I think it's going to generally shape out to be. Here's where we are in October. This is the red line is right here. That's what we're seeing right here. This little rally and decline. That's this and this. So we're right here at the start of it. And we can take a shorter term cyclical view. That's the green line. Prices have followed that pretty well this year. It also suggests some bouncing back and forth in October, and then we go off to the upside, especially around the end of the year. So there's a view for you, a roadmap of what to expect for stock prices in the United States of America. Well, I hope you take this lesson away. Remember, the trend is up always. The stock prices from 1937 to 1990, what was the trend? The trend was up. Oh yeah, there were declines along the way, but had you bought any of those declines at any place in the decline, here or here or here or here or here or here or here, you made money just buying and holding on. And then here's the trend then that we just saw from the 1980s up to date. Same thing. Yeah, we have declines sometimes, but the trend is up always. We have bear markets along the way. What does that last? 9 months, 10 months, 2 months. So these bear markets don't really last that long, do they? Look at that. And they're not perpetual. Keep that in mind as a trader. And maybe this lesson will really drive it home for you. Some people call me legendary Larry Williams now. Well, I started trading in 1962. That's when the so-called legend of Larry Williams began, 1962. Had I bought $10,000 of the Dow Jones in 1962 and never done anything, today I would have about $2.2 million, because the trend is up, right? So just buying $10,000 worth of stock, well, in 1962, I didn't have $10,000. I was a college kid. So that's one thing to keep in mind, but also that long-term perspective. But also, here's a really important lesson. Had I bought the 30 stocks in the Dow Jones Industrial Average, I might be broke now. I think it's only 1 or 2 stocks that are in the Dow Jones now that were in the Dow Jones average in 1962, which means you have to upgrade. So you can buy an index fund, they will index to the Dow, they will upgrade the stocks in the index. You don't have to do that. So again, you don't have to do anything, but make certain you're buying a fund that is indexed, that does have new additions, so you're following the Dow or the S&P 500. And if you did that, like I said, look, I didn't do anything. $10,000, $2.159 million without ever having a day of work. Wow, that's a pretty good job, isn't it? So you might want to think about that. The really big, easy money, the stock market is a money-making machine, maybe the best money-making machine ever, if we just have the patience for it to grind out the profits. Well, I hope you've learned a lot today about the short-term aspects of the market, what influences the market, and especially about holding on in the marketplace. I'm going to say goodbye now because I'm going back to the future because I live in the future, and I hope to see you there, and I'll be wishing you good luck and good trading.